Silver moved last week in a way that tells you more about structure than sentiment. It wasn't news driven, it wasn't retail driven, it was mechanical, and if you understand what that means, you're already ahead of most people watching price without watching behavior. The pattern looked erratic on the surface. A sharp move up, then a pullback that seemed to erase momentum. Retail saw volatility, they reacted emotionally, some chased, some exited, most froze. That's the tell, because while retail interprets price as information, smart money uses price as a tool. And the tool they used here was liquidity extraction. Here's what actually happened. Silver spiked enough to trigger stop losses and attract momentum buyers, volume surged, and then it reversed, not because sentiment shifted, but because the spike itself was the setup. Institutions weren't buying the breakout, they were selling into it, and then they accumulated lower. And after retail had already committed or capitulated, this isn't theory. It's visible in the order flow, the timing, and the way price compressed. Immediately after the move, most people misread this because they assume markets move on. Belief, they don't. They move on positioning. And positioning is about liquidity, where it sits, who controls it, and when it gets pulled. Retail operates on fear and greed. Institutions operate on structure and timing. When you see a move that doesn't align with fundamentals or sentiment, you're not seeing confusion, you're seeing coordination. The psychology behind this is simple but brutal. Retail buys momentum because it feels safe. They sell drawdowns because it feels dangerous. And that predictability is the edge. Smart money doesn't need to outsmart you. They just need to know what you'll do under pressure. And pressure is created deliberately. The spike wasn't random. The reversal wasn't panic. It was a liquidity grab executed in a market where most participants are reactive, not strategic. Fear and greed don't operate on logic. They operate on recency and emotion. When price rises fast, retail assumes continuation. When it drops fast, they assume collapse. Neither assumption accounts for intention, and intention is what separates passive participants from active architects. The institutions moving silver right now aren't guessing. They're building positions based on timelines you're not watching, and catalysts you're not pricing in yet. This matters because it's repeating. Silver isn't moving on fundamentals yet. It's moving on positioning ahead of fundamentals. That's a critical distinction. It means the big players are preparing for something that hasn't been priced in by the majority. They're not waiting for confirmation. They're accumulating before the crowd understands why. And that accumulation phase looks boring, confusing, or even bearish to those who don't recognize what's being constructed. The strange moves you're seeing aren't signs of weakness. They're signs of preparation. Markets don't move cleanly when large. Players are repositioning. They move in ways designed to shake out weak hands, trigger automatic orders, and create the liquidity necessary for size to enter without moving price prematurely. If you're reacting to each move emotionally, you're participating in someone else's strategy. So what does this mean for you? First, stop interpreting price moves as signals of strength or weakness. Start interpreting them as tests. Tests of liquidity, tests of conviction, tests of who's still holding and who's about to fold. Second, recognize that volatility in a suppressed market isn't chaos. It's preparation. When price compresses after a spike, that's not failure. That's reset. It's setting up the next move. Watch for these signals going forward. Sudden volume spikes with no corresponding news, sharp reversals that trap breakout buyers, and quiet accumulation periods where price drifts but doesn't collapse. Those aren't signs of a dying market. They're signs of a controlled one, and controlled markets eventually release, but only when the setup is complete. The next move in silver won't announce itself. It'll happen after retail has been shaken out, after positioning is locked in, and after the majority has stopped paying attention. That's not speculation. That's how coordinated markets operate. The only question is whether you'll recognize it when it starts, or whether you'll be the liquidity they're extracting. What happens next isn't about prediction. It's about recognizing patterns that repeat, because human behavior repeats. And right now, that behavior is being managed. Something unusual is moving through silver right now. Not the kind of price action that happens naturally when buyers and sellers meet. The kind that happens when someone with size wants to control where it goes. The chart doesn't lie. Sharp spikes followed by immediate reversals. Volume surges at levels that trap retail positions. Patterns that repeat with precision across weeks, sometimes months. This isn't coincidence, it's coordination. Look at the structure. Silver rallies into resistance, momentum builds, retail piles in chasing breakout confirmation, then the floor drops. Stop losses trigger in waves. Liquidations cascade. The price snaps back below key levels within hours, sometimes minutes, and when the dust settles, the same institutions that sold into strength are quietly accumulating again at lower prices. This isn't new, it's been happening for decades, but the frequency has intensified and the mechanics are becoming more visible. The historical pattern is consistent. In 2011, silver hit $50 before collapsing 70% in weeks. In 2020, the rally from $12 to $30 was interrupted by violent shakeouts that eliminated leverage positions before continuation. Each cycle follows the same blueprint: build momentum, attract capital, trigger liquidation, consolidate lower, then repeat. The players change, the structure doesn't. Who benefits from this? Follow the positioning. Large ETFs hold physical silver, but issue paper claims at ratios far beyond what they store. Market makers provide liquidity, but they also see order flow before it executes. They know where stops sit, they know where leverage is concentrated, and when those pressure points align, price can be moved with relatively small capital if the timing is surgical. This isn't about individual actors, it's about structural advantage. Those who see the full board control the outcome for those who only see their own position. Futures markets amplify the effect. A concentrated short position can suppress price during low liquidity windows, when retail notices the dip and sells, or when algorithmic systems trigger stop orders, the move accelerates. The institutions covering shorts buy back cheaper, and the cycle repeats. This isn't theory. It's visible in quant reports, in exchange data, in the timing of moves that consistently occur outside major trading hours. The psychology is deliberate. Retail investors enter based on momentum or narrative, inflation hedges, industrial demand, supply deficits, all valid themes. But themes don't control short-term price. Execution does. And when price moves against a crowded position, fear replaces conviction. The exit becomes reflexive. That's the trap. Not the initial move, but the emotional response it triggers. Markets don't punish belief, they punish positioning when it's predictable. This matters because it defines who survives and who exits at the worst possible time. Every manufactured dip shakes out weak hands. Every false breakout resets confidence. The result is a market where conviction alone is insufficient. You need structure that withstands manipulation. You need awareness that price is not always reflecting value, sometimes it's reflecting control. So what changes? Not the system, but your relationship to it. Risk management isn't optional in a manipulated market, it's the only variable you control. That means position sizing that survives drawdowns. It means watching order flow, not headlines. It means recognizing when sentiment is being engineered and refusing to react on cue. The indicators that matter aren't moving averages or oversold signals, they're open interest shifts, ETF inventory changes, and leverage ratios in futures markets. Those show intent, not opinion. Protecting yourself means understanding the game being played. Don't chase breakouts without confirmation. Don't use leverage that forces exits during planned volatility. Don't assume price reflects fundamentals on any given day. It reflects positioning, and positioning can be manipulated. What you can do is position for the longer move while surviving the short-term traps. So that requires patience, discipline, and a refusal to react emotionally when the pressure is designed to make you react. Silver hasn't finished this cycle. The setup is still live. Next week will clarify whether the breakout holds or whether this was another engineered flush to reset positioning before the real move. Watch how it behaves at the levels that matter, not where it should go based on fundamentals. But where the structure shows control, that's where the next signal comes from. Silver is moving in a way that separates those who understand structure from those who react to noise. The pattern forming right now isn't new, but most won't recognize it until it's already played out. If you're holding silver or considering a position, what happens in the next few weeks will either validate your thesis or expose a gap in your timing. Short-term volatility has compressed in a way that historically precedes sharp directional moves. Volume is thinning at key levels, open interest is shifting, and the spot-to-future spread is behaving inconsistently with the broader commodities complex. This isn't random, it's coordination masked as confusion. When price action tightens like this while fundamentals remain unchanged, the move that follows is rarely gradual. Look back to early 2020, just before the March collapse and the subsequent surge. Silver traded in a narrow band for weeks, while macro risks built quietly in the background. Then it broke. The same pattern appeared in late 2010, right before the parabolic phase that caught most investors too late. The setup wasn't visible in headlines, it was visible in positioning, in the quiet accumulation by entities that don't announce their intentions. That's what's happening now. The difference is scale and the geopolitical backdrop. Central banks are still net buyers of gold, but industrial demand for silver is accelerating without corresponding supply expansion. Mining output remains constrained, recycling rates are declining, and above-ground inventories available for delivery are thinner than exchange data suggests. Meanwhile, the dollar's strength is masking underlying tension in currency coordination between major economies. Silver, as both a monetary and industrial metal, sits at the intersection of these pressures. When that intersection tightens, price doesn't drift, it snaps. There are two scenarios playing out simultaneously. In the bullish case, silver breaks through resistance and retraces its historical relationship with gold, catching institutional and retail momentum at the same time. In the bearish case, a forced deleveraging event in commodities or equities triggers a liquidity scramble, and silver gets sold alongside everything else in a rush for cash. Both scenarios are structurally plausible. The question isn't which is more likely, it's which one you're positioned for and whether you understand the timing signals that separate them. What matters now are the levels and the behavior around them. Watch how silver responds at $32 and $29. Watch whether it holds support during equity weakness or breaks correlation. Watch open interest in the futures market, particularly in the front month, and whether large traders are rolling forward or closing. Watch the gold-silver ratio, not for predictions, but for signs of divergence that indicate changing market priorities. These aren't lagging indicators. They're structural signals that reveal intent before headlines catch up. The psychological dimension is equally important. Retail investors entered silver heavily during the last breakout cycle, and many are still holding underwater positions. Their behavior at key levels will amplify whatever directional move begins. If silver pushes higher, relief turns into greed and momentum accelerates. If it drops, capitulation creates the kind of flush that institutional players wait for before re-entering. Either way, the crowd becomes fuel for the move, not the driver of it. This phase isn't about waiting for confirmation from analysts or media coverage. By the time silver's move is being discussed widely, the strategic positioning window has already closed. The entities that profit from these moves don't react to breakouts. They position before them. They read order flow, track delivery demand, and understand the constraints in physical supply that the futures markets can temporarily ignore but not indefinitely suppress. The warning signal isn't a headline or a price target. It's the convergence of tight supply, rising industrial demand, weakening confidence in fiat currency coordination, and a technical setup that mirrors previous inflection points. History doesn't repeat exactly, but the mechanics of how markets resolve tension remain consistent. Compression leads to expansion, silence leads to volatility, positioning determines outcome. Silver's next move will be decisive. The setup is complete. The question is whether you're reading the signals or waiting for someone else to tell you what they mean. If you're in, know your levels. If you're watching, know your trigger. The market has already spoken, most just aren't listening yet.